Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. This morning I was thinking about the brand new options trader, just wanted to take their first tentative steps into this big, scary world of options trading. So I did a little experiment with AI. Got my phone out, and I'm going to read this to you. I actually asked AI, hey, if I wanted to dip my toe into the world of options trading, what would be considered the most conservative strategy to start with? So, what do you think the answer might have been? I think a lot of you already know exactly what it probably is. Yep, AI said, oh, well, most conservative option strategy widely considered to be covered calls or cash secured puts. So we're going to be starting dipping our toe in the waters of options trading from that beginner perspective. We're going to be trading a covered call for the very first time. So we're going to be talking through the process of planning and placing one's very first options trade. If it happens to be a covered call, that's what we're going to be covering. Should be a great discussion. Before we get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. I see a lot of familiar names, a lot of first-timers, I think. So hello to all of you. Eva and Irma, Sia, Robert, Jim, Richard, Rojo, Sharon, on and on that list goes. Thanks for giving us your time and attention each week. We always appreciate your attendance and your contributions to these discussions if you're one of those that are returning. If you are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy that recording. It's a great way to watch these webcasts. But if you'd like to be here in the live stream, this is a Tuesday webcast series. We kick things off promptly at noon Eastern time. Now, I also want to let you know that my very good friend Mike Fairborn is going to be hanging out in the chats. He's going to be addressing any questions here. He's going to be keeping an eye on the chat window. And if there are questions that come in that I can't get to, Mike's going to be there to pick up my slack. Believe it or not, Mike and I have been working together now for more, well, not quite 2 decades. We'll say it's closing in on 2 decades, isn't it, Mike? In any case, Mike brings a ton of experience to this discussion. Thanks for having my back there, Mike. Mike and I would also like to issue an invitation to everybody listening. You should be following your favorite Schwab presenters on social media. You can find Mike on X at Mike Fairborn CS. You can find me on X at Cameron May CS. You can also follow me on LinkedIn. Just go to linkedin.com/in and then throw in another slash, and it's Cameron May CS. But let's get into this discussion of planning and placing a trader's very first covered call position. Now, as we do this, we need to bear in mind some important disclosures because risk is real. So this is important information. Options carry a high level of risk and are not suitable for all investors. The covered call strategy can limit the upside potential of the underlying stock position. Schwab does not recommend the use of technical analysis as a sole means of investment research, and investing involves risks, including loss of principal. All right, so let's set an agenda for what we're going to be covering today. Obviously, we have a lot of new people watching. I can see that in the chats. So I want to go to a pace that everyone can follow. So we're going to talk about what a covered call is. We're going to use real-time examples to explore an example covered call scenario, the pros and the cons. And then by the time we're done, we're going to be planning and placing an example covered call trade. Now, I am going to kick things off, though, with a quick revisit of last week's trade, just to show that this is a part of an ongoing series of webcasts. And you can go back and watch the previous webcasts if you weren't here to see those. But let's go right into it. And as we do, very first thing I want to let you know is that we're going to be using some trading software that's called Thinkorswim throughout today's demonstration. If you don't have Thinkorswim, you can download it for free from within your Schwab Online account. So you just log into your online account, go to the Trade tab right up there at the top, and then click on Thinkorswim Desktop, and that downloads this software to your computer. You can actually just click right there where it says Learn how to enable Thinkorswim, and then just follow the on-screen prompts. But that'll download this trading software onto your computer, and then you can just double click on the icon for Thinkorswim. It looks like this blue splash right here to launch the software. When you go to launch, it'll bring up a login screen like this. It'll say, welcome, here's Thinkorswim. Put in your login ID, and it'll also ask for a password. And this is where the panic might set in. Oh no, I don't have a Thinkorswim username and password. Yes, you do. Just use your Schwab login. So you can log in here. You can choose between accessing your live portfolio and trading that, or you can use a practice account known as Paper Money. So Paper Money is what we're going to be using today. Let's go right to that Thinkorswim desktop Paper Money platform. And I do want to follow up, first of all, on last week's trade. Just very quickly, it was a trade on Walmart. Here's what we saw on Walmart. We talked about this last week. Walmart seems to run up and pull back, run up and pull back. Recently, it had made another run up. It had pulled down to an apparent price floor. And we put ourselves in the shoes of an option trader who was planning and placing their very first long call trade. So we bought a long call for $6.05. We put it in order to sell it if we can get out for $9. And yep, we made about a 50% return. Let me show you that history here. If we go to our account statement and we look back 10 days, we can check our trade history and we can see right here is that Walmart position. Bought the contracts for $6.05. We sold for $9 for a $2.95 realized gain. Obviously, some small commissions there to be paid out at both ends of that trade, but a nice little trade. Now, if you weren't here to see last week's discussion, let me make a recommendation for you, because we have webcasts about trading and investing that run all through every market day. Yep, from opening bell to closing bell, all throughout the day, we're doing a whole bunch of different webcasts on a range of topics, and those can be found on our YouTube channel. So if you haven't done this already, while you're here, make sure you go down and click on the subscribe button on YouTube. It doesn't cost anything, but that subscribes you to our Trader Talks Schwab Coaching webcast channel. And this is where you can find, yes, you can join our live streams right here. You can also find playlists of our previous webcasts. So let me click on playlists, and I'll just show you right where last week's discussion can be found. Got a bunch of different series. Mine actually happens to be listed down toward the bottom. There's Getting Started with Options. I'm just going to click on View Full Playlist. And there's last week's discussion, Beginner's Guide to Planning and Placing Your Very First Call Option Trade. So you can go back and see the plan for that Walmart trade that we did. Now, for those who are here in the live audience, I'll just put a link to this. I'm going to put a link in the chat window. It'll take you, you can just click on that. That'll have you directly link to that playlist for watching after this webcast is over. All right. So that gets us up to speed on last week's discussion. Let's set the stage for today. Let's say that we are a brand new options trader, never traded options before. We just want to dip our toe in the water. What kind of market circumstances are we possibly trading in? Let's look at what's going on with the S&P 500. All right. It has been a great run. So I've just typed in the symbol here on Thinkorswim. Went to charts. Let's type in SPX to look at the S&P 500. And we all know probably that since April, it's been a fantastic market for the bulls and for strategies like covered calls, which is a bullish strategy. It's a bullish income strategy. But since April, markets have been running up and up and up and up. So for stock investors, that's a great run. However, over the last couple of months, things have kind of settled down a little bit. We've been more up and down, more primarily sideways than anything. So during this time frame, stock ownership hasn't been terribly productive. Now, a trader might decide to just wait this out. They might feel like, oh, there's nothing I can do. However, there are some who understand options that may turn to, instead of a capital appreciation strategy like just pure stock ownership, maybe they can use those existing stock shares and sell calls on those shares and get a potential income during these quieter periods, right? So that's going to sort of stand as our setup scenario for the sort of logic of why a trader might consider entering into a covered call. It's an income strategy that's sometimes employed when a trader thinks that stock prices aren't really set to go up very rapidly. Maybe there might be another approach that might be employed. All right. So now, if you're not familiar with covered calls, and we have, 225 people watching right now, something like that, chat in, let me know. Are you familiar with covered calls? And if not, that's great. Nobody just is born with inherent knowledge. of how this stuff works. So chat in yes or no. Are you familiar with this strategy? Let's talk just right at the beginning, just what a covered call is. And it begins with stock ownership. So I'm going to go to another account. So we actually placed this long call last week in our margin account. Well, I'm going to go to our example IRA. And as we go to the activity and positions page, you'll notice down here, we own some shares of Apple. Okay, so I'm getting some yes. Someone says familiar, but you haven't done any. A lot of people saying no, not yet. All right. Oh, CS says you learned from me last year or earlier in the year about covered calls. All right, very good. But it all begins with stock ownership. And as you can see right here in this example portfolio, we own 100 shares of Apple. And those shares are trade price $255.03. Right now, the market price of Apple is close to $285. So a nice little run. We're up about $30 per share. But what's going on with Apple at the moment? Apple, much like Walmart, has had a recent tendency to run up and then kind of just waffle around for a while. And then it runs up and it kind of waffles around for a while. It runs up and it kind of waffles around for a while. And on each of these three recent advances in price, it went up about $30. Up about 30 and then sideways, up about 30 and then sideways, up about 30 and then sideways. Let's say that our hypothetical Apple shareholder, they own their 100 shares of Apple, and they see that recently we're down about 265. Right now we're up at about 285. So if recent history holds, and there's no guarantee that will, but if that history holds, we might bump our heads at or near, let's say, 295. That would be another $30 off of these recent lows. So I've made some drawings. If you're wondering where these blue lines come in, I just drew them in there. There are some drawing tools available right down here in the lower right. We can draw rectangles and ovals, make arrows and make text notes and draw trend lines. So that's what I've done here. But just up above, I've drawn in a line here at about 295. That's proportionately an equivalent move to what we've seen several times in recent history. So let's say that our Apple owner here thinks, all right, we got a little bit of room to go, and then we might top out. I wonder if there's some other way I could add a little bit of cream to this cake. Yeah, that's not a very good analogy, but you get my point, right? Yeah, in this case, what we're going to do is plan and place a covered call on Apple. Now, for the benefit, for those of you who don't know what a covered call is, it's a contract between two market participants. I'll use that fancy term for two traders or investors. They're going to enter into a contract where they're agreeing to maybe exchange shares of Coach Cam's shares of Apple here, right? Here's the deal. We're going to get into a contract. I'm going to go to the trade tab and look at the available contracts for Apple. But basically, standing in the shoes of someone who owns 100 shares of Apple, we're going to agree to maybe allow someone else to buy those shares from us at $295 per share. We're going to get into a contract where somebody pays us for the right to buy our shares from us. And at what price? $295. So let's go to that trade tab. And if we type in our symbol right up here on the trade tab, we'll notice down below is something referred to as the option chain. Now, if you're new to options, this is going to be unfamiliar territory for you. But really what it is a list of possible contracts we can get into. And they vary in timeline, in the length of time that we can get into those contracts. So for example, there are contracts that we can get into that are done in 3 days. There are also contracts that the trader could get into that go out 780 days. But let's just say that our trader here thinks, well, you might go up, bump our heads at 295 and then go sideways. And if this is anything like the last few moves, we might be below 295, including the start from back here, for maybe like a month and a half. All right. So how about we go to this trade tab and let's look at a contract where we're giving someone else the right to buy our shares for the next 45 days or the next month and a half. So if you want to know what the rest of this means, these contracts are through the 16th of January of 2026. That's what that means. And very importantly, each of these contracts are for the potential exchange of 100 shares of stock. That's what the 100 means. So I'm going to click on that arrow next to the 16th of January of 2026, and that's going to reveal more information. So what we're looking at now are call options on the left and put options on the right, and we're going to focus over here on the calls on the left. And if you'll notice, right down the center is something known as strikes. Think about it this way. We're about to strike a deal with someone else. And the deal we're going to strike is they're going to pay us, and in exchange, we're going to agree to maybe sell our shares to them for $295 per share. In other words, we're striking a deal to maybe sell our shares for $295. So let's scroll down here a little bit, and let's find $295. And then we're going to look at the $295 calls. All right. So as we look over here to the left, we can see two columns, bid and ask. So when we trade stocks or options or other securities, typically when we buy something, we pay the ask price. Hey, how much you want for that? Oh, you're asking $5? Okay, I'll pay you $5. If we want to sell something, we sell for the bid price. Hey, how much will you bid for this thing I'm trying to sell? And we sell to the highest bidder. So I'm going to look at the $295 strike, maybe strike a deal to possibly sell our shares for $295. And you'll notice the bid price is $490 and the ask price is $495. Or in other words, call options are trading for about $4.90 to $4.95. I'm going to spell this out for us using our scratch pad. So this is our example trade. First of all, we own 100 shares, not Sagra's. Let me work on my typing. And they're currently trading for about $285.25. I'm just going to make a note of that. Right up here is the last trading price for Apple. So that's about where we're trading right now. And I want that as an important reference point. That's how much our shares are currently worth. And then we are intending to sell into a contract. We're going to sell the 16th of January, $295 call for, and it looks like between $4.90 and $5. Let's say we're able to get somewhere in the middle of that. Let's call it, well, you know what? I'm just going to say $4.90, right? Want to sell the contract, someone bids $4.90 and we sell to that bidder. Okay, somebody just asked a very good question. What if the bid-ask spread, or in other words, the difference between the bid price and ask price is very large? That's a great question. Because if we do this trade right now, what we're essentially accepting is a payment of, and this is conceptual until it fills, but we're going to accept a payment of $4.90 from someone else to get into a contract. And if we decide, oh, no, I don't want to be in this contract anymore. Let me buy out of this contract that I sold to get into. We might have to buy out for, let's say, $5 that we'd be paying a little bit more right now. Now, if we had to pay a lot more, in other words, if there was a big difference between that bid price and that ask price, that's a sign of less liquid options. And for some traders, they just prefer to avoid. So that is something that we keep an eye on. All right. Something that a lot of traders emphasize here. All right. But in any case, this is the deal. This is our whole example trade. And let's give that a title. This is known as a covered call, typing. Anyway, but it's a combination of two things. First of all, share ownership. And second of all, getting into a contract to maybe sell those shares. So in this example, just to revisit the logic of exactly what we're doing here, if we place this trade, we're conceptually accepting a payment of $4.90 per share. Now do the math on that. This is for the potential exchange of 100 shares. So how much are we actually getting paid? $4.90 per share times 100. $490 goes into the portfolio if this is the price we're able to get. But in exchange for that $490, someone else has the contractual right to buy our shares, not on the 16th of January of 2026, but any time between now and the 16th of January. But at any time, they can say, hey, Cameron, I have a contract that says I can buy your shares for $2.95, and they can just buy those shares. That's the deal. This is known as a covered call. Now, here's the way that I think about why this is referred to as a covered call. It's not the way everybody, it's not like this is officially the reason, but it's the way that I think about it. Back in the day, we didn't have computers to do these transactions through. So, 30, 40 years ago, most people would have been doing these sorts of things over the phone. And if someone had the right to buy, let's say, my shares of stock for $2.95, conceptually, they might give a phone call. Hey, Cameron, I have the right to buy your shares for $2.95, and I'm calling to exercise, to assign that right. Buying your shares for $2.95. And in that case, I might say, okay, mystery caller, whoever else you are, I got your shares right here. I got you covered. And I deliver the shares for $295. Now that $295, just to address a common misconception, is some people will think, well, they've already paid me $490, so what, they owe me $290.10? No. If they decide to buy the shares, they pay $295 in addition to the $490 that was already paid. So if we wind up having our shares called away or sold through the contract, that would be the equivalent of selling the shares for $299.90 in this case. So Kelly says, why would someone benefit from buying shares at a higher price of $295 versus just buying directly through the market through their brokerage? Excellent question. And the answer is they probably wouldn't buy for $295 when the shares aren't worth that much right now. But this is known as the covered call, okay? So let's talk about some of the pros and some of the cons and how this thing might work out, how it might fail, and also make sure that we plan and that we actually place the trade, because for some people, that's a major hurdle, okay? So what should we do first? Should we just place the trade, sort of get that out of the way? Let's do it. I'm going to go, we're already on the trade tab. We already have Apple loaded. I'm going to go to the 295 strike, and to sell that contract, which is actually no longer trading for $490, it's now over $5 to $5.10. Let's go ahead and sell that contract. Let's see if we can get $5. That'll make my math nice and round, easy. I like that. Let me click on that. So, oh, by the way, backing up one step, to sell a contract, we go to the bid price for the intended strike price, and I'm just going to click on that bid on Thinkorswim. Just clicking on that creates a sell order. Now, I know that selling sounds like we're exiting something. Nope. Sometimes in trading, we sell to get into something. In this case, I'm selling a contractual promise. Someone is paying me $5. There's a hint. You get paid when you're selling something, right? But someone's conceptually paying me about $5 for a contract that says that I will sell the shares of stock to them for $295 at any time between now and the 16th of January. All right, so let's just make sure that we're just selling one contract, because each contract represents an obligation to maybe have to sell 100 shares of stock, and we only have 100. So let's just do one contract. Now, G7 Expert says, could you show a chart of the contract you pick? I could. Yes, these are chartable. That tends to have limited application, at least, I can't speak for every trader out there, but generally speaking, the fluctuations of the value of the option are much more involved than the fluctuations in the value of a stock. And so looking at those fluctuations on a chart might not be terribly insightful for the trader. Anyway, but let's sell this one contract, the 295 call. Now over here, we can make a decision regarding how much is the least we're willing to accept. Right now, those contracts are trading somewhere, we might be able to collect as little as 505. We might be able to get more than that. Let's put in a limit order saying that we're willing to accept not a penny less than $5. So either this trade fills for $5 or more, or it doesn't fill at all. Obviously, there's a risk in doing that, but that seems to align okay with how these things are actually trading at the moment. I'm going to put in a limit order. That just means, hey, $5 is my limit. I'm not willing to get into this deal for less than $5. And I'm going to submit this as a day order. Rogers says, is there a way to see the stock price at the time the option is filled? We could go back and look at a tick by tick accounting, but we can also just estimate that by looking up here as we submit the order. We can keep an eye on it. But in any case, I'm going to click on confirm and send. And we haven't placed the trade yet. This just brings up a confirmation screen that gives us this kind of is reassuring, isn't it? Hey, we're in the simulation paper money account. No real risk on this trade. This is just a practice account. In any case, we're going to attempt to sell one of these 16th of January 295 calls for $5. If we're able to get that, that would give us a credit of $500 minus a 65-cent commission. So a total net credit of $499.35 or more. If we can collect a higher price, that's just sort of the minimum. But let's see if we can get this filled. I'm going to click send and see if this fills. If we're placing a trade and we want to monitor the progress of that trade, we can go to the Thinkorswim monitor page and look at our working orders. These are orders that have been placed and haven't been filled. But there we go. Actually, we just filled. Sold that call for $5.20 per share. So let's update our notes over here. So we actually we're not going to sell, but we sold that call for $5.20. But here's what just actually happened. We own 100 shares of Apple. We are now in a contract where someone else has the right to buy those shares of Apple for $2.95. They can do that at any time up to the 16th of January. After that, the contract expires if it's not assigned by then. In exchange for that, they paid us $520. Now, that is one of the pros of this strategy. Let's go through some of the pros and some of the cons. One of the pros is the potential for income. We were actually just paid $520, but we also recognize that came with a big asterisk. It came with some obligations. So we'll talk about those in just a moment. Number two, some traders really are drawn to this as an initial sort of dipping your toe in the water kind of a trade. This is a trade that has a high probability, not probability, probability of profit, because we're starting off with a credit. And one of two things is ultimately going to happen. Either the other party decides to buy our shares, in which case we sell them for $2.95. You saw earlier in this presentation, we bought those shares for $2.55. Even compared to current prices, that would be an improvement. All right. So that could happen. If they buy those shares, they pay us another $2.95 in addition to the $5.20 that's already been paid. And that's a profitable outcome. Now, the other thing that might happen is that they choose not to buy the shares, in which case we keep the shares that we already owned. We were already exposed to the market risk of those shares anyway. But once the contract is over, we now have $5.20 of realized income in our pockets. So those are two outcomes. Either the contract gets assigned or it doesn't. Now, there's a third potential outcome. That's we decide to do something with that contract. We're not actually stuck in this contract. If you're wondering, so we're on the hook until the 16th of January? Yes, unless we choose, and we have to make sure that we're trading good liquid options. But if we choose to buy out of this contract, that's a possibility. All right. But so these are the pros. Income, a higher, let's call it higher than 50-50. All right. It can vary from one contract to the next, but better than 50-50 chance of profit. And finally, an advantage here is there is a credit generated here. There's not actually, somebody might say, well, how much does it cost to do this? Well, selling a call actually doesn't cost anything. It brings money into the account. For some traders, that's attractive. Now, I'm not going to stop there because then it would sound like a sales pitch for a strategy. And I don't do that in these webcasts. We talk about the pros and the cons of market approaches. And the viewers are just left to weigh the pros and the cons for themselves to decide whether this strategy is ever going to play a role in their portfolio. I am just here as the educator. All right. What are some of the cons? Well, number one, got to have shares. You might think, well, what's the problem with owning shares? Well, there's market risk in owning shares. There's also a cost associated with owning shares of stock. If we have made a promise to sell shares to someone else and that we want that position to be covered, we need to own those shares. And 100 shares of Apple right now costs $285 a share. That's a $28,500 cost for the share ownership. All right. Now, number two is we might have to sell those shares. Let's say it this way. Might, not mate. Oh, boy, I'm on a streak today. Might have to sell. No. Might have to sell those shares. Now, the trader can select up front the price at which they're agreeing to sell the shares. So there are no surprises here, right? We looked, we saw there was a big list of prices we could agree to sell the shares. We chose, in this example, $295. So if someone else decides to buy those shares, we better be happy with it. We better be okay with that because that's a possibility. Now, a third potential con is that there is limited profit. Yeah, there's a high probability of profit, but that profit potential is limited. Let's go look at these. I want to explore what might happen between now and the 16th of January with the stock price, and then explore it. Let me give a little bit more space here. I'm going to hide this left column for just a moment. That just gives us more working room on the platform. And I'm going to add a couple more things up here under our chart settings. First thing I'm going to do is go to what's called the time axis. That's just the time on the chart. And I'm going to check a box that says Show Expiration Friday. This contract we got into expires on the third Friday of January, and I want to see that on the chart. Now, the next thing is I want to be able to peek out into the future, out to the 16th of January. Right now, I'm only seeing 10 days out in the future. It might take something on the order of more like, 35 days, 35 trading days. Let's click Apply and click OK, and you'll see what that just did. By checking the box for Show Expiration Friday, it's showing a dashed line for the 16th of January. And by adding the 35 bars to the right, it just created more white space out here so we can take a peek out in the future. And it helps us visualize what might happen. All right. So now that we're in this contract, let's talk about how this contract might play out. So most likely our stock is either going to go up or it's going to go down. Right? Let's explore what might happen if we go up above 295. Oh, I don't want to draw a channel. Let me just switch up my drawing tools here. Come down here to our drawing tools. I'm going to choose the trend line tool. And then let's draw a hypothetical from today. Let's say that we run up above 295 and we're at basically $300 or anywhere above. And let's revisit our contract over here. So come the 16th of January, if the stock is up here at $300 and someone has the right to buy those shares for $295, are they going to do it? Yep, they're going to do it with very rare exceptions. Someone has the right to buy our shares for $295 when they're worth $300. Of course they're going to do that. So they buy the shares at $295. And we wring our hands and say, oh no, we just sold the shares for $5 less than they're worth. Well, that's true. But also we sold the shares in this case for that would be $10 more than the shares were worth on day one. So against that benchmark, it's actually a success. And you already saw at the start of this webcast, we actually purchased these shares when they were trading for about $255. That might be the reason why the trader was willing to accept this deal in the first place. In any case, we sell the shares for $295. And we accomplish something known as the maximum gain of this trade. What is the maximum gain? Well, from day one, the shares were worth 285. And if we sell at 295, the most the shares could make was basically, let me do a little bit of rounding. Can you forgive me for this? Look, the shares are only trading for just a few pennies over, well, they're actually 286. I don't want to botch this up too much, change the math too much. But from the moment we started our trade, when we agreed to sell the shares for 295, that put a cap on how much we could make on those from there on. $9.75 was the most we could make from right here up to there on the shares. But we collected a payment of $5.20 to do that. So combining those two factors, there's just a shade under 15 bucks on this example that the trader could make. It would be $14. Somebody double check my math. I'm doing this in my head. If I mess something up, let me know. But basically $14.95 is the most we can make. Is that a limited profit? Yep. For some traders, you have to be aware of that. It's a possible con. Okay. That's the maximum gain of this trade per share. What's the maximum loss? Well, we own 100 shares that are basically currently worth $285.25. And what can happen to the value of shares given 45 days to move? It could collapse. What if this happened? What if the shares started to fall? Well, our trader here, let's say the stock is down here at 265 at expiration, at the 16th of January. We refer to that as expiration. Well, if somebody has the right to buy our shares for 295, but they're only worth 265, are they going to do it? Almost certainly not, unless they get some bizarre wild hair. They say, Cameron, keep your shares. I'm not paying you 295 for them. So now I'm sitting on a loss. They were worth 285. The shares are only worth 265. However, got a nice little consolation prize in the form of the premium that was paid, this little income that was generated. So it reduces some of that pain. It didn't eliminate it, though. And super emprendedores, I don't know what that means, but is there a protective strategy if price drops? You'll notice there's a little bit of protection here, a little bit of a buffer, but if the stock falls by more than the income that was received, then the income isn't adequate to offset that market risk on the stock. All right. So a heavy drop in the stock price stings. Interesting, it stings a little bit less due to the covered call that it would have if we just kept the stock and we didn't have a covered call to help out. But that's not the maximum loss. What is the maximum that can be lost on shares? Well, if they were worth 285 and they drop to zero, now is Apple going to drop to zero in the next, is the company, Apple, going to fall out of favor entirely with shareholders, go bankrupt, get delisted, and the shares are worth zero 45 days from now? Almost certainly not, but it's still just barely inside the realm of possibility. So that's the worst case scenario. We lose the full value of our shares with this little consolation prize. And how much might we lose? Well, if we lost 285, but we had a 520 income, that would leave us with $280.05 of loss potential if Apple were to go to zero and get delisted between now and the 16th of January. There's also one final thing that I wanted to talk about, the break even. At what point does this trade just break even? Well, CS says the chances are zero. They're not exactly zero. They're awfully close, but not exactly. Never know what can happen in the next 45 days. Interestingly, the break even is also $280.05. So why is that? Well, if our shares were worth $285 on day one, and we got that income of $5.20, and then the shares fell $5.20 in value, just envision this. We just collected $5.20, and on the 16th of April, our shares have fallen in value by $5.20, and we've lost exactly the same amount on the shares. as we collected an income, that's a wash. Well, 285 minus 520 is $280.05. That's the break-even point for this trade. It'd be right down here. So those are important considerations for our trader. All right. But that is sort of a covered call in a nutshell. Now, there are a couple of more things I want to talk about in the last minute or so, but we've weighed the pros and the cons of a covered call. We've actually placed a trade. I just wanted to address, when might a trader decide to get into a covered call? And when might they decide to exit if it isn't going according to plan? Well, getting into the covered call, as I mentioned, is typically either done at a point when the trader thinks the stock is already going down, or a point at which they think it's likely to start going down. So in this case, that might be at 295. We just don't think it's going above 295. Might as well get into a contract, is the logic of their trader here, where we agree to sell our shares at a price that we don't think the other trader is going to be able to, or going to be willing to pay. Now, but we're in this covered call. When might we decide to get out of it? The bottom line there is, if the stock starts to misbehave, if it starts to fall hard, we're taking some lumps here. And if the stock starts to, well, if the trader ever concludes, you know what, I don't want to be a shareholder of these shares anymore, and I don't want to wait until the other guy makes up their mind, well, at that point, they might choose to buy the contract back and then sell the stock. Right? But guys, we've accomplished what I set out to do today. This is just an introduction to trading covered calls. If you want to learn more about this, I actually have a weekly webcast series. It's called, get this, see if you can remember it, Trading Covered Calls, and short puts. Might want to check that out on our list of webcasts. But it is time for me to let you go. I hope this has been an interesting introduction to trading covered calls. You might be able to see why some traders consider this to be one of the most conservative approaches. I don't ever want to assign an absolute label like the most conservative, but AI seems to think so, and a lot of other traders probably seem to think it's the same thing because of the high probability of success, the fact that it doesn't cost any additional money to do this sort of a strategy, but it does come at some, there are associated cons. We have to own the shares. We have to agree to sell the shares for a specific price and those sorts of things. But I want to make you aware, if this is your first exposure to Schwab Education, there is a whole range of educational resources available to you, starting with our YouTube channel. So one final reminder, if you haven't subscribed to our YouTube channel yet, do that right now. Doesn't cost anything. Just go down below the live stream, click on the subscribe button. But our Trader Talks Schwab Coaching Webcasts is our channel on YouTube, where you can join our live streams like this one, and they happen. We have what, 6 or 7 or 8 live streams every day of the week on a range of topics. So you can join the live streams here. You can find the playlists of previous webcasts right here. Now, another suggestion I have for you is that you follow your favorite Schwab presenters on social media. You can find, for example, Mike Fairborn is helping out there in the chats. Mike can be found on X, and his handle is at Mike Fairborn CS. You can find me on X at Cameron May CS. There's my profile. I'm in front of this, Scone Castle, I believe that one is, in Scotland. In any case, give me a follow here, and I frequently post on X. If you reply to one of my posts, I try to reply right back to you, and allows for interaction when the camera's not on. Now, as of a month ago, you can also follow me on LinkedIn. This is brand new. So you can track me down on LinkedIn. The address is linkedin.com/n/Cameron May CS. You can follow me here. I post on LinkedIn regularly now, and if you reply to one of my posts here, I try to reply right back to you there as well. So follow on either platform or on both, and neither one costs anything to give me a follow. But time for me to let you go. Thanks for giving me your time today. I did see that there is a survey in the chat window. So if you do me a favor, click on that survey link if you're in the live stream audience right now. It's only 2 multiple choice questions, and then a comments box and a suggestion box. And if you fill that survey out, I promise you, I read through every point of that data. I read through the comments. I read through the suggestions. It's always helpful. All right. Now, a final thing is I can see, and we've had hundreds of people watching this live stream. I can see that 76 of you already clicked the thumbs up or the like button. I definitely appreciate that. That's like a pat on the back to your presenter, but it also gives us a boost in the YouTube algorithm. It sends the message to YouTube that you enjoyed the webcast, and they'll show that video to more people, help more people find out things like how to plan and place their first covered call trade. All right, everybody. Thanks for watching. I will see you in a future webcast. I'll also look for you on social media, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.